Now we can shift to the export market and look at what's happening with U.S. exports and what is going to be some of the headwinds that we see coming as we talk about, where the future of U.S. exports going to be over the next, call it, 6 to 12 weeks. Here you can see gasoline had a nice little pop. It was across the board in terms of bigger than year over year, 5-year average, which is nice to see. Again, we talked about how we thought there could be a little bit more going into Mexico, into Latin America. That did come through. Again, it's going to be lumpy, especially as we have some ports shutting down. We're going to start to see pilots starting to announce when the last shipment can go, and then if the ships can't get out in time, they're going to have to shelter in place, dock up to make sure that they can weather the incoming hurricane. So this is something that we think is going to be, again, nice to see, but an ebb and flow. But there's going to just be an overarching pressure, especially as we have Europe putting out more and more gasoline, especially as they see their local demand start to slow down. They had a nice little recovery. Now we're starting to see some pressure on that. If you remember last week and the previous few weeks, we've been talking about how distillate was going to come under pressure, especially as we had some Asian flow coming over into the European markets. And that's something that is going to be a continuous theme, especially as we start to go in a little bit more detail on why we think that's going to be consistent. And it's just going to kind of keep us at this depressed level on a go-forward basis. If you can see, propane remains elevated. Again, that's going to also be impacted by the storm. The bigger one is going to, for us, is crude oil exports. So if you remember last week, we thought we were going to go closer to about 2.6. Instead, we had a big surge to about 3.5. And then we said, okay, well, that's, again, timing is always the thing, which is why you have to look at more of an aggregate. And now we're back to kind of where we thought we were going to be, which is at 2.6, 2.7. As we go through the remainder of the week, again, it's going to come down to when things are shut down, the loop shut down. So it's going to impact exports, imports, depending on which direction it's facing at that point. And then it's going to be something a little bit bigger in terms of where some of those impacts will be. So we're confident saying that, as we look forward, let's strip out hurricane issues. Let's take some of that away. And we start to look at where are U.S. exports going to go over the next 6, 12, and, let's just say through the rest of Q4. Based on what we're seeing, we think that there's going to continue to be pressure into Europe. We have it came out just now in terms of, what the issues are. Saudi actually cut their official selling price into the Mediterranean as Saudi Aramco cut most OSPs for November to Northwest Europe and the Med. And that's also coming on top of Libya getting to, we've guided closer to 360,000 barrels a day by essentially the 10th, and we're right there. They're at about 310. They're now guiding to getting to about 390,000 barrels by the end of October. So again, that's going to be additional competition. We've already seen Urals trading at a month low into Europe. So that's going to shift to how does the U.S. compete into Asia, and we're starting to see some of those flows slow down. So again, it's just going to weigh on getting some of these additional exports off the coast, which again is coming full circle. If you remember back in segment 1, when we talk about Cushing builds and some of this pressure in the market, this is where we're making that connection, where we're just going to have to see the Cushing come at a steeper discount to accelerate some and essentially compete and push some of the pricing down at the Louisiana Light Sweet level and the Magellan East Houston to get some of those flows into the market. And Saudi and Libya and Russia are going to put pressure onto us into Europe, which means that we're going to have to price a bit more aggressive to get into the Asian markets. And here is, or we could try to go cheaper to get into the European markets. It's just going to be a little bit of a battle as we look at market share. But now as we shift into gasoline exports, this gives you some clarity as to, we were expecting that we were going to get a little bit of a drop further to the 5-year average. Instead, we got that relatively big surge. And it just means that this week and next week, we're going to see some of that pullback. Again, sometimes with exports, it's just a matter of timing when we're picking stuff up, when it's being released. And that's why we have to look at, just where things are. And typically we get it right as we look out on that 4-week average. So that's going to see that drift lower, especially as we have additional pressure on some of our refined product exports. Distillate, we said that we were going to have a drop. The drop was a bit more aggressive than even we were expecting. But we assume that we're going to be at below that 7-9 year average or so. we're going to be bouncing below that level just because we're going to have a continuation of pressure into our typical markets as we have European flow coming out. As I talked about in the second segment, the arbitrage flips. So typically it's U.S. Distillate exports go from the Gulf of Mexico into Europe. Instead, we actually have an adjustment now, and actually the arbitrage is coming the other way, where it makes sense to buy European. So again, that's going to just put additional pressure on our exports, which is going to remain at these depressed levels, which if you think back to, well, what does that mean for the bigger picture? It's like, well, okay, we have some strong tailwinds in terms of diesel demand going into rail and into trucking. But again, we're also losing some of that export demand, which is going to offset some of those tailwinds. Again, coming back to those tail and headwinds, which is going to kind of keep us in this relatively tight range. Now, as we shift and look a little bit broader, so Fujairah has moved back, and they're now in line with where they were in 2019, which is nice to see. Again, we talked about some of the dynamics where some additional ships have been put into the cycle just because we can't replace crews because of COVID. There's a lot of disruption in the general supply chain. But overall, it's something where we think Fujairah is going to start to creep higher, especially as we have exports increasing of refined product from some key areas, which I think will end up finding a little bit of a home in Fujairah. The bigger issue was in Japan, where we actually had a relatively large increase in both not only just oil, but also in distillate. And that actually reversed us, and we actually had a build. And if you look at where we were in 2019, this is more of a counter-cyclical build. We talked about how Japan was pretty aggressively buying some spot cargoes, and we thought they got some good deals, they got some decent flow. And now that has picked up some of those imports into Japan. It's pulled a little bit more offshore. From offshore onto onshore, which is also nice to see, moving some of that through, but we're not seeing that really turn around into any real demand. And then the U.S. did have that small build because this is looking at crude on a commercial level and distillates. And so we kind of got that little bump up. Now, as we talk about, and I think it's important to appreciate where we are in the floating market, because the Middle East has started to creep higher in terms of the oil and floating storage. West Africa, we're starting to see a little bit more of an increase, especially as we have additional competition specifically into some of these areas. And we have Nigeria talking about exports of 17 grades are going to increase by about 12% in November. Again, something we'll talk about in a bit more detail. But again, it's going to put more crude on the water. And if you look at global storage, it's flattening out. We had some decent moves lower as some of that went from offshore to onshore, and we're starting to see that build back up, even though oil in transit is slowing. And even though it's slowing, as we said, as we get into November, we see some additional increases. The UAE pared back, Saudi increased. And we had a net growth out of the GCC countries. Nigeria's growing, Russia's growing, Angola's down a little bit. But again, you're starting to see some of this competition. And as we've talked about, the demand for dollars just means that some of these guys that are supposed to cover for their cheating just won't be able to. And that's going to put additional crude on the water. And when we look at Shandong, as we keep talking about, we continue to see this creep higher. We're now approaching the highs that we had in January and February in terms of the crude and storage. We think that just based on how everything is slowing in the country overall, you're going to see additional headwinds, and we'll talk about that in the economy show on why those headwinds. But just to be clear, if you have Asia growing and specifically China, that's just going to put more pressure. And again, it's going to push some of that flow back into some of our markets. And this is where we should see it originate. And we see additional pressure coming from Singapore as builds remain robust across the refined product space, which is just they're going to have to do something to get it off the water, get it into the market. And we're starting to see some of this competition increase as we have new volume replacing it. So they have to get some of the cycling. So this chart here is looking at total. We want to get a little bit deeper into the middle distillate when we're thinking about diesel, some of that middle cut. You can see that the trend is up. And even though there's been some ups and downs, even with a shift of product into Europe, we're still seeing this elevated move We're as we talked about last week, we see China increasing exports as they have to because they're running tight on storage space onshore, which again is just going to put more on the water. And then when we think about on the water, where is it going to appear? And Fujairah is going to be an interesting spot because as we talked about, they're back into that 2019 zone. And we think that they're going to start to see some of those increases, especially as the shipping demand has now been met in terms of, getting bunker fuel onto some of these vessels. And you're going to start to see this slow build, especially as we're in not only shoulder season, but you have an increase in refining capacity that's happening within the MENA market or the Middle East, North Africa. Japan, it's just important to see just the sheer size of the increase because this is really where we saw the biggest jump in volumes of when we factor in crude oil and distillate, which again put, when we look at some three bellwethers, that's why we actually had a net increase because, U.S. was relatively flat. Fujairah is back down to 2019 levels, but Japan was the big driver. Now, just to round this out, and then we'll go more in depth in the OPEC show, you're starting to see this tightness in the market where this is looking at it into Asia. And Asia, it's just there's not that much demand. So they're looking to get a bit more competitive because there's not as much demand. And you can see that we're starting to close that gap between the average of Oman, Dubai. FOB is just free on board, which is just a metric in terms of how you take delivery of the product. And you can see that where the tightness is continuing, but the bigger focus outside of just this is the spread between Saudi Arabia extra light crude and heavy oil narrowed by 20 cents for November sales. And it's just important to appreciate that the discount for heavy oil is really starting to erode, and we've seen some premiums in some markets just because we have that shortage of heavy crude in the market, which is putting that additional that's eroding some of that premium. And here is just, even though the Middle East saw some tightness, it's important to consider of where is there going to be more fight for market share, and it's really shifting into Europe and the Mediterranean. So they're getting a little bit tightness, again, not much, but it's still a small increase. But we did get an offsetting discount, and it was a bigger discount than based on some commentary than expectations into the Mediterranean and Europe. So these are going to be some of those factors that, again, if Saudi Arabia is saying, look, we're not going to compete as hard in Asia right now, we don't see demand as robust, but we want to compete more in Europe, again, that's going to impact the way the U.S. can get crude into the market. And these are going to be overall bellwethers, especially as we go into, well, why is there more competition? Where is European demand? And those are things that we're going to cover in the economy show as we start going more in depth into, well, what does Asia look like? What does Europe look like? And why is Europe slowing a little bit? So as we go forward, Thursday, we're going to have our economy show. Friday, we're going to have our favorite, the primary vision, Frac Spread Count. And then we're going to have a little bit of a special update, one on China in terms of what is happening with grains, with food security, a quick update on Azerbaijan and Armenia. And then we're going to have just a quick OPEC high-level supply-demand breakdown. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.